Listen carefully. Something just happened that most people will completely misread. Overnight, COMEX silver jumped more than 5% in a single session. Not a slow grind, not a technical bounce, a gap, a violent repricing. And while most traders are staring at that green candle thinking relief rally, they are missing the real story. Because while paper just blinked, physical silver never went down, it stayed elevated, it stayed scarce, and that changes everything. Let's be very clear about what just happened. A 5% move overnight is not noise, it is not random, and it is definitely not a normal technical bounce. In a healthy market, prices drift. They move gradually. Buyers and sellers negotiate in real time. Gaps do not appear unless something breaks. And when a gap appears, it tells you the market was forced to reprice faster than it wanted to. That is exactly what we saw here. This was not silver, climbing slowly from 71 to 76. This was silver being dragged higher in a single session because the paper market could no longer justify pretending that 71 was real. This was not optimism, this was surrender. That is why calling this move bullish momentum completely misses the point. Momentum implies enthusiasm. This move was reluctant. It was reactive. It was paper blinking under pressure. Think about the context. For weeks, COMEX silver sat disconnected from the physical world. Paper prices slid while physical markets refused to cooperate. Premiums stayed wide. Availability stayed tight. Dealers did not lower quotes. Industrial buyers did not step back. They leaned in. Paper ignored that reality as long as it could. But paper can only deny physical scarcity for so long. When the gap between what the screen says and what metal actually costs gets too wide, something has to give. Either physical collapses or paper snaps higher. Physical never collapsed. So paper snapped. That 5% gap is not a sign of strength. It is a sign of stress. It is the paper market starting to acknowledge that its pricing power is weakening. It is the first crack in the illusion that futures alone can dictate value when metal is scarce. And here's the part most traders do not understand. Gaps like this do not close politely. Markets do not gently glide back into balance after denying reality for weeks. When price discovery has been suppressed, the release is violent. This is not paper leading physical. This is paper chasing it. 71 was never sustainable when real transactions were happening closer to 90 and above. The market knew it. Dealers knew it. Manufacturers knew it. The only place that fiction existed was on the screen. So when you see a 5% gap and think relief, think again. Relief rallies come after fear exhausts itself. This was not exhaustion. This was recognition. Recognition that the paper price fell too far. Recognition that the crash was mechanical, not fundamental. Recognition that physical scarcity never went away. This move does not resolve the problem. It exposes it. Because even after a 5% jump, paper silver is still far below where the physical world is actually transacting. And that means the repricing process is not finished. It has only just begun. Here is where the real story separates from the screen. While paper silver was collapsing, physical silver around the world did something that should have been impossible. It refused to follow. Let me repeat that. Paper crashed. Physical did not. In Dubai, physical silver traded around $96 per ounce. Not a quote from last week, not an estimate. Right now. In Australia, dealers were asking roughly 93. In Canada, close to 89. In Russia, EBS near 98. These are not rumors. These are not projections. These are real transaction prices from major hubs where metal actually changes hands. And this is what makes the divergence so dangerous for anyone relying on paper signals alone. In a normal market, when the paper price collapses, physical prices follow it down. Dealers lower their asks. Premiums compress. Buyers hesitate. They wait for confirmation. That is how price discovery is supposed to work. But that is not what happened. When COMEX silver plunged, physical markets did not flinch. They tightened. Premiums expanded. Availability shrank. Buyers did not step back. They stepped forward. That behavior tells you everything you need to know. It tells you the paper crash was not driven by supply increasing. It tells you demand did not suddenly disappear. It tells you fundamentals never changed. What changed was leverage. The paper market flushed positions. Margin calls hit. Forced liquidation took over. Screens printed fear. But the physical market saw through it. Physical buyers understood that a paper-driven crash does not create metal. They looked at silver trading around 71 on the screen and said, that price is fake. That is not where metal clears. That is not where supply meets demand. So they did the opposite of what textbooks say. They bought more. This refusal of physical markets to acknowledge the paper crash is the single most important signal in any commodity market. It tells you the crash was artificial. It tells you price discovery is happening somewhere else. This is not just divergence. This is system stress. When paper and physical disagree this violently, the market is sending a warning. One side is lying. And history tells us it is never the side that requires delivery. Paper can trade all day without consequence. Physical cannot. Every ounce sold must exist. Every contract fulfilled must be delivered. And when physical prices stay elevated during a paper crash, it means one thing: scarcity, not perceived scarcity, real scarcity. The kind that makes buyers ignore screens and focus on supply. And that is why the 5% gap matters so much. Because paper is not leading here. It is following. It is chasing a reality that physical markets never abandoned. The crash did not break the market. It exposed where the real price lives. Now, we need to answer the most important question. Why did physical silver reprice higher while paper was collapsing? This was not emotion. This was not speculation. This was survival. Physical markets are not driven by traders. They are driven by manufacturers, by people who actually need silver to keep factories running. Electronics, solar panels, medical devices, data centers. None of these industries can function without silver. And none of them can wait for paper markets to figure themselves out. When you are an industrial buyer, you do not care what COMEX says silver is worth. You care about one thing: can you get metal? And if the answer is uncertain, price becomes secondary. That is exactly what is happening now. China has announced a full silver export ban starting January 1st, 2026. Not a restriction, not a quota, a ban. That date matters more than any technical level on a chart. Because China is not just a producer. China is the refining hub of the world. Roughly 70% of global silver flows through Chinese refining and processing. Ore from South America, Africa, and Australia gets turned into bars, pellets, and industrial forms inside China. When that door closes, the rest of the world does not just lose supply. It loses processing capacity. And industrial buyers understand this math. If Chinese silver disappears in just over a year, where does replacement supply come from? The answer is nowhere fast. Mines cannot ramp overnight. Refineries cannot be built in months. Logistics cannot be rewired on demand. So buyers do what rational actors always do when faced with a hard deadline. They front-run it. They do not buy 1 month of inventory. They buy 3. They do not negotiate premiums. They accept them. They do not wait for confirmation. They secure supply. This is not hoarding. This is procurement. Paying $96 in Dubai or $98 in Russia is cheap compared to the alternative. Factory shutdowns, missed contracts, lost revenue, layoffs, regulatory scrutiny, shareholder backlash. For an industrial buyer, the question is not, is silver expensive? The question is, what does it cost if I cannot get it? And the answer is catastrophic. That is why physical prices rose while paper collapsed. The paper market was flushing leverage. The physical market was securing survival. And this is the most dangerous setup for the paper system. Because industrial demand is inelastic. It does not disappear when prices rise. It intensifies, it accelerates, it pays up. So when you see physical silver holding near the mid-90s while paper struggles to reclaim the mid-70s, understand what you are witnessing. This is not enthusiasm. This is urgency. This is what markets look like when supply physics overrule financial fiction. To understand why the paper market crashed when it did, you need to understand December. Not as a month, as a deadline. December 31st is not just the end of the year. It is a balance sheet freeze. It is the moment every bank, every hedge fund, every clearing member must report exactly how much risk they are carrying, their leverage ratios, their liquidity coverage, their balance sheet usage. And anything that consumes too much balance sheet going into that date becomes toxic. Commodities sit at the top of that list. Silver futures require daily margin. They are volatile, they create gross exposure, and gross exposure is expensive when regulators are watching. So when risk managers look across portfolios in late December, they are not asking what trade they like. They are asking what trade they can afford to carry. Silver fails that test. This is why the sell-off did not happen gradually. It happened suddenly, violently. On December 29th, that was not random. That was compliance. Institutions do not wait until December 31st to see if they are compliant. They make sure they are compliant days in advance. Risk systems flag positions automatically. Traders get calls they cannot ignore. Cut exposure now. Free up balance sheet now. There is no debate. There is no discretion. Positions are sold immediately. And here is the key point most people miss. When institutions are forced to sell quickly, they do not sell what they hate. They sell what they can sell fast. They sell liquid instruments. They sell futures. That is why paper silver collapsed, even though nothing changed in the physical world. This selling had nothing to do with supply, nothing to do with demand, nothing to do with China. It was mechanical, regulatory, temporary. Physical buyers understood this instantly. They saw the paper price falling because of accounting rules, not fundamentals. They saw a fake price created by forced liquidation, and they bought into it. This is why physical prices did not just hold. They rose, because physical buyers were not constrained by year-end balance sheet rules. They do not report to regulators, they report to production schedules. Now, fast forward to January. The reporting date has passed, the forced selling is over, institutions are no longer under pressure to shrink exposure. They can reestablish positions they were forced to exit, and that is what the 5% gap represents. It is not enthusiasm returning. It is normalization beginning. It is the paper market unwinding an artificial crash caused by compliance deadlines. This is critical, because it tells you the crash was not a signal, it was noise. The real signal was physical strength throughout the entire episode. And when paper starts to recover after forced liquidation ends, it does not recover to where it should be. It recovers to where it must be. That process has just begun. A lot of people are reaching for history right now. They are saying this looks like 1980 or maybe 2011 all over again. That comparison is understandable, and it is dangerously wrong. Let's start with 1980. Back then, the silver market was driven by a single concentrated force. The Hunt brothers used massive leverage to accumulate futures contracts and physical metal. They tried to corner supply. Prices exploded from $6 to nearly $50. But here is the key detail most people forget. There was plenty of silver in the world. The shortage was artificial, created by leverage, sustained by margin. When the exchange changed the rules and raised margin requirements, that leverage collapsed. The Hunts could not meet margin calls. They were forced to liquidate. The price imploded. The rally died because it was built on borrowed money, not real scarcity. Now look at 2011. That rally was driven by fear and speculation. Quantitative easing, inflation anxiety, retail excitement, futures and exchange-traded funds flooded with money. Prices ran from the high teens to almost 50 again. But once more, supply was adequate. Industrial demand was growing, but manageable. There was no physical bottleneck. When margins were raised repeatedly, leverage traders were flushed out. The price collapsed. Same story. Too much leverage. Enough metal. Now look at today. The structure is reversed. Today, leverage is everywhere, but metal is not. You can raise margins. You can flush speculators. You can crash the paper price. But you cannot create silver. You cannot print it. You cannot mine it overnight. You cannot refine it faster just because futures sold off. That is the difference. In past cycles, paper demand overwhelmed a market that had supply. Today, industrial demand is overwhelming a market that does not. Solar installations are accelerating, electric vehicles are scaling, data centers are expanding, medical technology is advancing. All of it requires silver, and that demand does not negotiate with charts. This is why paper crashes fail to fix the problem. In 1980 and 2011, margin hikes solved the excess. They popped the bubble. Today, margin hikes only expose the shortage. They shake out leverage while leaving physical demand untouched. That is why physical prices stayed high during the crash. That is why premiums expanded. That is why availability tightened. This is not a speculative bubble waiting to burst. This is a supply-constrained market waiting to be repriced. You cannot pop physics. You cannot liquidate scarcity. You can only reprice it. And that repricing process does not happen smoothly. It happens in gaps, in stress, in recognition moments, like the 5% move we just saw. History does not repeat here. It inverts. Here is what matters now. Watch 5 things: physical prices, premiums, availability, industrial contracts, and whether paper keeps gapping higher. If physical holds while paper chases, the repricing continues. If physical runs, paper loses control entirely. Either way, scarcity wins. This 5% gap was not the end. It was the first admission. In surplus markets, paper sets the price. In deficit markets, physical does,